Millions of miles from Earth, millions of tons of resources drift through the inner solar system, untouched. Extracting them represents the ultimate industrial challenge. For years, popular media has focused on the idea of the trillion-dollar gold asteroid, a single massive strike that will eventually return to Earth and permanently crash our precious metal markets. This narrative misreads both the geological composition of these asteroids and the complex microstructure of terrestrial financial markets. Humanity has already mined an estimated 219,890 tons of gold. Because the vast majority of this metal remains in vaulted inventory, gold behaves as a massive financial stock rather than a simple annual commodity. Understanding when or if this market could ever buckle requires a look at the specific thresholds of supply absorption. The data suggests gold and silver are uniquely insulated compared to other rare elements. The true economic vulnerability to off-Earth mining lies in the smallest, thinnest global markets. The only realistic targets for Earth return economics are the platinum group metals, specifically rhodium and palladium. Rhodium functions as a highly specific industrial consumable. Automotive emissions control accounts for roughly 87% of its total global demand. To put the scale in perspective, the annual mined value of gold sits around $501 billion. The entire annual market for rhodium is roughly $6.4 billion. That narrow end-use structure means even a tiny disruption in supply can trigger violent price swings. We saw this in 2021, when brief power outages at South African mines caused rhodium prices to surge to nearly $30,000 an ounce. Viable space mining business models center on these hypersensitive industrial catalysts. This image displays the pockmarked, composite structure typical of actual near-Earth objects. These targets are complex silicates containing only fractions of valuable metal. Because the concentration of valuable elements is so low, finding the ore is the first step. The operation must perform beneficiation, crushing and separating the target minerals from the surrounding useless rock. This 3D model shows a 500,000 kilogram metallic asteroid. Using iron meteorite median grades, it contains 40.8 parts per million of platinum group metals. After stripping away thousands of tons of dead weight, this massive body yields only 20 kilograms of actual platinum group metals. Moving 500,000 kilograms of raw asteroid mass into cislunar space costs billions of dollars. Returning all that unrefined dirt to Earth's surface would guarantee a massive financial loss. To make the transport math work, a company has to isolate and upgrade that 20 kilograms into a highly refined concentrate entirely in the microgravity of space before the return trip begins. Engineers are currently testing catalytic dissolution using deep eutectic solvents in laboratories, but proving the chemistry in a lab is decades away from building a space-qualified automated refinery that handles its own waste and power generation. The gating step to influencing metal prices isn't navigation or excavation, it is zero-gravity industrial processing. Once that refined metal finally reaches Earth, its impact depends entirely on the structural depth of the market it enters. Gold operates as a stock-dominated market. Central banks and investors buy it to hold it, creating an immense buffer that easily absorbs new supply. Left, gold's production is a tiny trickle into a massive 220,000-ton reservoir. Right, rhodium is flow-dominated. The 21 tons mined annually flow directly to factories. Drop identical asteroid deliveries into both. The gold reservoir barely ripples, but the narrow rhodium pipe violently overflows. A market's vulnerability to mining is a function of depth. Thin, flow-dominated structures are mathematically fragile. We calculate exactly how much off-Earth metal breaks these markets using a reduced-form supply shock model. This equation projects price response by adjusting asteroid supply against a market's elasticity. Setting the threshold for a material market depression at a 20% drop. To crash gold, an operator must deliver 5,579 tons from orbit annually. To crash rhodium, they only need 2.21 tons. Delivering thousands of tons of gold is technologically implausible, but returning 2 tons of refined rhodium falls squarely within the payload capacities of our future commercial mission architectures. Knowing the math is only half the picture. we have to map those thresholds against the actual engineering timeline of the commercial space industry. This timeline charts milestones for space extraction. For the next 15 years, the primary target is extracting water for cislunar propellant. By the late 2040s, pilot missions could return material. Rhodium's tiny market means it will experience this pressure first. Platinum and palladium require a much higher delivery rate, tens of tons annually, to move their markets, pushing their realistic vulnerability windows out into the 2060s and 2070s. For the foreseeable future, the space economy will build infrastructure to support itself in orbit, leaving Earth's mail markets largely undisturbed. When those Earth return operations finally do launch, they will run directly into the ultimate financial hurdle, the pricing discipline paradox. If a mining firm scales asteroid deliveries enough to crash the global price by 20%, they instantly destroy the revenue projections they used to fund the mission in the first place. This chart shows the paradox in action. If rhodium drops by 20%, the new market ceiling is roughly $7,520 per ounce. To remain a viable business, the firm's all-in delivered cost from deep space must stay completely under that new depressed floor. Any business model that assumes it can scale massive extraterrestrial supply without triggering a corresponding price collapse is economically inconsistent. Returning valuable materials back to Earth requires navigating immense physical friction during re-entry, but the economic friction they face is even harsher. Asteroid mining is a complex intersection of microgravity processing bottlenecks, structural market vulnerabilities, and strict economic margins, where the thinnest markets will break first.